All right, well, welcome everybody to the Locking Your Success Trading Market Update for November 24th, 2014. Before we get going, we would like to remind you that the presentation is for educational purposes only. We're not broker-dealers or financial advisors, and we're not making any specific trade recommendations. Also, please be aware that we do use hypothetical computer-simulated trades during the presentation that are believed to be as accurately represented as possible. However, live results may vary. And also, make sure that you understand all your risks in trading options prior to placing any live trades. If you're watching this on YouTube or some other venue, come on over to our website, check out the M3, the Bearish Butterfly, Rock M21 group coaching, and trading triangle programs, and join our mailing list and get your free reports, the 7 secrets to becoming a successful trader, and sign up for this free weekly webinar. Okay, so let's take a look at what's going on in the markets. All right, so last week we had another completely, if you look at the weekly bars, another completely flat week in the Russell. We had a little bit of decent range movement back and forth during the week, but we closed pretty much flat. And at the same time, we're continuing to get the same old thing in the other indices, where the SPX, the Dow, the NASDAQ, we all got a reasonably sized up move last week. So the other indices continue to grind up as the Russell continues sideways. Nothing has really changed here. I'm still short-term bearish on the Russell because I'm thinking as soon as the SPX and the Dow and the NASDAQ drop out, we're going to get that the pullback we've been kind of looking for. One of the things about this time of year is it's typically they have patterns that happen fairly consistently year over year. What we usually get coming into December, if you look at last year, we usually get a grind up into December, through October, November. That's fairly normal. We normally get some sort of a pullback first 2 weeks of December, and then we get a fairly large up move into the last 2 weeks, after which we tend to level off. So I would assume that so far everything's acting normal, and I'm still thinking that we get some sort of, in the next 2 weeks, some sort of a pullback. I don't think it's going to be a huge pullback, but we get some sort of a pullback, and then we continue higher into the end of the year. And then in January, we'll have to see where we are and make our predictions from there. But, for the Russell, I'm still thinking that probably means that we pull down a little bit lower, maybe 1140, 1130 area, and then start to continue higher, into the end of the year. Like I said, that's what usually happens. We don't know that that's what's going to happen this year, but I do take that into consideration, knowing we're pretty overextended in most of the indices. So we should be, again, that's my outlook. Short-term bearish, a little bit longer-term bullish on the Russell here. All right, so now that that's over with, let's take a look at the positions here. Last week we had the only November trade we had open was actually a November V Condor, and I don't need to show you that. If you remember, we were just kind of waiting for that to expire, which it did. We just let it expire, and that pulled a small loss last month of, I think it was a few $100s. So we already went over the November results, so we can kind of move forward from there. If we look at our December V Condor, this had no adjustments last week. We had to buy back a couple of these 1220 calls earlier in the month. Profit and loss is coming back. I mean, it's only down about $800 here. The position looks like this. So if we get what we think we're going to get, some sort of a pullback, a continual grind up into this area here at expiration, this should do okay. I mean, we should have profit. It's not going to be a banner month here. Again, we got beat up with that large up move, but it's looking fine. The next trade we have on, I'll show you the T-log here just in case you don't remember. Right? Like I said, we had to actually do, we actually had to do a roll-up in this, which is very, very unusual earlier in the month. So Anyway, that's why it's written. That was a pretty aggressive move earlier. So let's go back and take a look for a, I'll talk about the bearish butterfly trade in a little bit. We'll take a look at what we have for the M3 trade. So if I go into back trader here, and we go to Monday, this is the position we looked like last week. So we had essentially 1130 butterflies on with 5 1130 1140 verticals. We had a deep in the money call at 1,000, and the position looked like this, which was perfectly fine. If we shoot over to Friday, what I did is what I did here is 3 1130 1140 verticals and 2 1130 1150 verticals, just to bring our delta down under minus 50. So as of Friday, with the up move, we're officially outside the tent now. We tend to cut our delta limits down a little bit, and I just wanted to bring this down to around minus 50. So we did those verticals. As of right now, again, this was put on 56 days to expiration. It went through that very, very large up move, and we're just kind of bouncing around the break even down $500. It's periodically during the day, it's up a little bit of money. But as long as the market's going to continue to fly, then we're going to be continuing to hold our money around here. If we get some sort of a reasonable back down for a short period of time, then this should be up a reasonable amount of money. But as of right now, everything looks really good, and that is the December M3. The delta on the edge of the tent is minus 75. I was over minus 75. I had to make an adjustment. I'm actually past the edge of the tent if you look at the fact that the tent actually crosses the T plus 0 line here. I mean, it's, plus the fact, too, earlier in the day, right, the market was up at the 1180 area. I had to make an adjustment this day. I could have done all 5 at 1140. Well, look, if I come back a half an hour, right, this is where we were, definitely over minus 75. So I should have done something here. I could have just done 5 of these, minus 5. Right, that would have brought me down. I could have even done less of those. What I chose to do, though, is we are past the edge of the tent. I like 75, like it around here. We're clearly past the edge of the tent. There's nothing wrong with doing 5. You should have done something, however minor. But that would have been probably 3 of these would have been the minimum. Where I went would be about the maximum you'd want to do, which would be minus 3 here and minus 2. Which by the end of the day actually puts us at about just under minus 50. So again, I didn't have to be this aggressive necessarily. I also didn't like my sag here too much, so I ended up just pushing it a little bit under minus 50. All right, so that was the December M3. The good part about this trade here is that realistically, you didn't have to do anything. You could have done, as far as this, you could have done 5, and realistically, whether you did it or not, the trade's going to work out fine. That's just the beauty. That's just the beauty of this system in general. So no problem there. All right. So I have. Do I ever consider rolling my single call option to a higher strike around 90 delta to take some money off the table? This is way deeper in the money than it has to be. We put this on at 1,000, and of course the market's gone up quite a bit since then. So it's definitely a lot deeper in the money than it has to be. The reality is that it's going to cost me money to roll this up. It's going to cost me, I don't know. I mean, if I roll it from here to here, it'll probably cost me $2. I'm going to have to give the market maker some money in order to do it, because it's a deep in the money option. So I mean, I'll tend to avoid rolling it. The position's more efficient with it down here at 1,000 than it is up the top. If I get to the point where, I mean, I have a $50,000 planned capital here. I'm only in it for 37,000. Certainly, if I was to the point where I needed the money, I'd roll it up. So if I have a compelling reason to roll it up, then I'm game for that. One of the reasons would be capital. Another reason, like you said, if I get really close to expiration, I might not want that risk on the table of having the option way down at 1,000. Maybe I'll want it at 1090 or something. That'll help with my downside risk, particularly coming into expiration. This far from expiration, at this point, we're not loaded with capital in trade. We have plenty of money left over to trade with. We have plenty of downside room here. We have plenty of time till expiration. I just don't see a compelling reason to spend the money to roll it. But there is at some point that I'll do that. How much time does it take me to evaluate my adjustments? About 30 seconds. I can look at a position and know if I should adjust it. So, and another thing too is, a lot of times when I'm making these decisions to adjust, one of the things you have to realize is, we're looking at this as a fixed number. So, we're going to come in here and, we're in back trade and we're saying, oh, we're minus 48. We don't have to do anything. The reality is when you're trading this might be bouncing from minus 48 to minus 75, or minus 45 to minus 75. So, I will look at this and get a range. So I'll come in here. I'll just look at the position and I'll say, and it won't necessarily be at 3:30 either. It might be at 3 o'clock or 3:15 or whatever. I want to make sure I leave myself enough time to make the adjustments I want to make. But in the examples, we're just doing them at 3:30. But if I see this ranging from, minus 50 to minus 90, actually, I think at this time before I made this adjustment, I'm pretty sure this was ranging basically from 70 to like 95, right? So I'm seeing it's ranging 70 to 95. I say, yeah, I just want to cut this down to around 50. What's that going to take? It's going to take 3 verticals. I tried 5 verticals here first, and at the time when I did it, it was like, well, I'd like a little bit more than that, so I just cut it just a little bit further. But realistically, it only takes a few minutes to evaluate it. It's there or not. One of the things is if you're trading, if you start overthinking things, you start bringing in information or making information up in your head that may or may not be there. So you don't want to over-evaluate it. It's not that hard. It's here. It's like, yeah, I'm past the tent. I should be somewhere between minus 75 and minus 50 delta. I'm a little bit over that. Let's make a small adjustment, bring it down under that. So it's really as simple as that. You don't want to be overthinking stuff here. Okay, so I'm just looking for a T-log. This is the current T-log for the M3. Like I said, we started at 14 butterflies. We did some verticals. We ended up rolling up. When we rolled up, I dropped my butterfly size back down, and then we added some more verticals in. So that's essentially how the trade's been going. And everything is good there. And let's see, although the protection tent is at the low side, but with the negative vega twice as big as the standard deviation, the theta, any concern? All right, so I'm just saying, is there any current concern about my, I don't fully understand what that question means, but I do not, I mean, I'm looking at the T+0 line. I'm just not concerned about the position. All it's going to do is going to control my delta. The only thing we add on sometimes for Greeks, as far as the static Greeks, right? Because we're looking at the static Greeks. So that's one of the things with this trade. I also want to be aware of what's going on out here. What are my Greeks out here? What are my Greeks back here? And we get into that in the course. And so I'm not just determining stuff here. I'm determining stuff. What does this look like here? What does this look like here? Your static Greeks, where you are, delta theta ratios and stuff. Realistically, if you get to a 1-to-1 delta theta ratio, It's essentially, it's not a problem. It just means you're not going to be making any money anytime soon. Um, I don't have a concern with it being 1/2 to 1. I don't even really have too much of a concern with it being over 1 to 1. I know I'm just pacing time at that point. So a lot of times if I am 1 to 1 delta theta, I will kind of either bring my delta down or bring my theta up, or a combination of both. But that's kind of a nuanced type of a thing. It's not necessarily necessary in order to be successful a long time, but it's something that you can do to help improve your performance a little bit in certain markets. If the market tanks, the vega is likely to increase. Yes, it will. The big negative vega could be a problem, right? Okay, so that's the question. He's concerned about negative vega. One of the things you find out about butterflies is they react extremely well to a downside move. Even though they're negative vega trades, they usually react better than a calendar to a move down. So, as you try to trade butterflies more and more, you'll probably recognize that. So, yeah, so I'm not concerned at all about a fairly monster move to the downside. Even if we get a 40-point down move tomorrow, I could say through experience that this T+0 line is going to remain relatively stable. If we get a 30-point down move today, then this will probably actually pop higher than it is, even though we have a volatility increase. So it's a little bit more about realizing how your position is really going to react rather than how you think it's going to react because you're posting a negative vega number. So no, I'm not concerned about that at all. All right, so for the M3 trade, would the delta limits be the same if we had 14 instead of 10? The delta limits are the same as long as I'm considering myself in a $50,000 position. So if I have 14 butterflies on with one call, I'm considering that a $50,000 position. I'm keeping my delta limits the same as a $50,000 position. But if I'm doing 14 butterflies in the context of I'm actually trying to do like a $70,000 planned capital trade, then I would actually increase my delta limits. So it depends. All right, assuming RUT hangs around 1175 today, would 1150 still be a good strike to use for the short options in the new December M3? Okay, so if you're going to enter a December M3 today, are we still looking at an 1150 short strikes? I'd probably be, I'd have to look at it. I'd probably still tend to be back maybe at 1140. If the market goes up, I'd certainly be interested in maybe an 1150, but I would tend to go towards the 1140. Part of that has to do with my opinion that the market's probably going to come down. January M3, I'll show you my January M3 a little later. All right, so that is all we have for the December M3. The December bearish butterfly, we'll take a quick look at that, which has had, the December bearish butterfly has had no adjustments. We ended up getting scaled in earlier in the month. We are only 2/3 scaled in. I thought we were completely scaled in. No, we are. We're 3/3 scaled in. Okay, we have a butterfly up here at 1090. We got some at 1190. We got some at 1170. We got some at 1150. Here is what our position looks like at this point. Like I said, no adjustments. And the other butterflies are up here on the call side. This is just looking really nice. If the market grinds down or grinds up or just kind of stays sideways, realistically, we're looking at getting out of this at a $5,000 or higher gain and loss on Friday, if that happens to be the case. And realistically, if the market is kind of flat this week or even slightly down or slightly up, then we'll probably hit those numbers and be out of this at the end of the week. If we get some wild movement, well, that's a different story. We'll just continue to roll with it. But this is a good-looking trade. All right, so is it a good idea to convert the December M3 into a rock if volatility allows for a rock trade? The volatility will not allow for a rock trade right now. We're actually still in, because I entered a rock position. Well, it may now. as of today, but as of last Wednesday, it did not allow for that. Yeah, so if you want to convert this into a rock trade, you just pull out the center strikes, right? So I don't have a problem with you going into a rock trade here. So you just pull out the center strikes and use your new delta limits. If the market continues to go up here, you go into a rock trade. I have no problem with that. That's perfectly legitimate. It's a little bit wider. It's less sensitive to back and forth. I'd almost like to rather see you in a rock trade than a bearish butterfly exploration guidelines. It's just a little bit easier to manage. Yeah, it's a little bit safer if you think the market's coming down, because now we have a whole different set of delta guidelines. We're going to be rolling this back into an M3 relatively quickly on the down move, so no problem there. Let's see. All right, so that's all we have for the December bearish butterfly. We have the December M3. That's all we had for open trades last week. But on Wednesday, we did have a rock entry to do, and I went ahead and did that. I actually did our entry test, and to my surprise, it put us into a M3 position. Usually when the market's been grinding up this long, the volatility skews are to the point where you'd be in a rock position. The fact that they're not is actually interesting. I'm not sure what that means at this point, other than the participants in the market do think we're going to get some sort of a reasonable move here. Whether it ever comes to pass or not, I don't know. But it would be much more normal with the type of market movements we've been having over the last couple of weeks to have a more skewed delta line coming in. But this is what we had. So apparently the participants in the market are concerned about some sort of a large move at this point, and that being the case, we're in the M3 trade. I entered with the 1130 strikes. We were at 1160. I went 30 points behind. I'm essentially in the same strikes as the regular M3. 8 shorts here at 1140, 2 shorts at 1150, and 1 call here at 1080. So the call's a lot higher. But this is essentially the same position as what we have on for an M3 trade right now. The only difference is this is actually going to be managed a little bit differently going forward if the market continues to go up. So here is the T-log for that entry. And if we go to Friday, let's kind of show you that. All right, it's up a couple $100, no adjustments. We're outside the tent, minus 52 delta. This is actually perfect. This is completely perfect, so liking that. Yeah, so I just get a question on whether people are expecting, the participants are expecting a large move up or a large move down, and we don't know. We don't know the direction of the move. You just know when the T+0 line's flat, people are hedging their bets for movement. Usually it's to the downside, but it could be to the upside. They're just concerned about the movement, so we don't know which direction it's going to be, which is often the bigger question with these trades is, are we going to get a large move or a small move? If we're going to get a large move, an M3 type of a position tends to be better. And the flip side is a bearish butterfly the rock trade tends to be better on a more smooth move. So this is the way that we entered here, and this is what our position looks like towards the end of the week. All right, and we also had 2 other entries for January, because it was 56 days to expiration as well. So I'll just show you the V Condor trade for January. And again, this wasn't entered because it was 56 days. This was entered because the other trade expired. So entered this on Friday with the 1260 shorts and the 1090 shorts, it looks like. Yeah, the 1090 shorts. And because of the weird delta skews here, I actually ended up putting this straddle in at the money. Usually the straddle is about 10 points under the money.
getting abnormally flat delta to the upside here, so I just went in at the money. So I could, not only could I see this in the December options, I can also see the same issue going on in the January options. Again, which I kind of find interesting, but I'm not 100% sure what that means at this point. So we will track that. It's just I mean, something's unusual, so just be aware of that. And on Friday, I thought that the gap up in the morning was a fantastic entry point for a bearish butterfly. So I kind of just pushed this in a little bit earlier in the morning, and the market was up higher than this, which is why I only went to the 1160 strikes. I actually wanted to do the 1150 strikes, but I couldn't do that and stay within guidelines because it put me this in the morning. It put me in a delta theta relationship problem. So I didn't do that. I went a little bit closer to the money at 1060s. Of course, the market was considerably higher earlier in the day. And this is what we look like at the end of the day. So here we are. We're in our January bearish butterfly, and we're good to go. I was asked if I like the January bearish butterfly position, and I do like it very much. I do think that the markets are extremely overextended. I'm at least short-term bearish in the near future, and that being the case, I really, really like this position here. Even if we continue to kind of grind up into the end of the year, if that does happen, then we're even more likely to pull back a little bit. And as we get 2/3 and 3/3 scaled in, it just looks like a really nice trade. So I really like this. VIX at the money premiums indicate an increase in volatility, and a move down is most likely. Yeah, usually an increase in volatility tends to imply that. Yep. So I'm not going to argue with that point at all. But as far as the skews being flat, that doesn't necessarily mean, in other words, a T+0 line being flatter than normal doesn't necessarily mean a down move. It just means they're prepping for a move in one direction or the other. So usually a VIX increase is going to indicate, yeah, people are buying puts, essentially. So if people are buying puts, then a lot of the bigger players in the market are thinking the market's, or at least they're very concerned about the market coming down, right? So there's a difference between thinking the market's coming down and being concerned about it. There's times when nobody's concerned with the market coming down, and there's other times when they're more deeply concerned, and right now they appear to be more deeply concerned about that. All right, so that's everything we have for the week. Make sure if you are a member of Options Tribe, you can join me at 10 o'clock for the live trade update there. And if you have any questions, be sure just send them in. And have a great Thanksgiving, everybody, and we'll talk to you next week.